Hello everyone, welcome to the another episode from Price Action series. Today we will discuss about top 16 candlestick patterns in your trading strategy, what are candlesticks in trading and why use candlestick charts. Okay, so let's get into the topic. Candlestick charts are one of the most widely used tools in technical analysis, offering traders a clear and concise way to interpret price movements over a specific time intervals. Each candlestick captures four key data points. Those are the open, high, low and close, providing a valuable insight into the market behavior within that period. In this guide, I will explore 16 essential candlestick charts every trader should know and how to apply them effectively in real world market conditions. Candlestick charts visually represent price action by displaying the open, high, low and close of an asset within a specific time frame. Recognizing key candlestick patterns helps traders anticipate market reversals, continuations and shifts in sentiment. Now, what are candlesticks in trading? Candlesticks are a key tool used in trading to represent price movements of an asset over a specific time period. Each candlestick displays four essential pieces of information. Anatomy of a candlestick. Open price. The open is the price of an asset at the start of the trading period, showing where the market begins. It provides a baseline for comparison with the close to determine whether the price has risen or fallen. Close price. The close is the final price of an asset at the end of the trading period. It is a key indicator of market sentiment and is compared with the open to assess if the market ended higher or lower. High price. The high represents the maximum price reached by the asset during the trading period. It reflects the strongest point of buyer interest before the price retraces. Low price. The low is the minimum price the asset reached within the trading period. It shows the lowest point of selling pressure before the price rebounded. With all this information derived from one humble candlestick, do not underestimate the value of using candlestick in your trading, as each candlestick tells a certain story. Use candlestick charts. Candlestick charts are widely used by traders because they provide a clear visual representation of price movements within a specific period. One of the key advantages of candlesticks is that they offer more detail than simple line charts, allowing traders to quickly grasp market sentiment and identify potential trends. The distinct shapes, colors, and patterns formed by candlestick provide deeper insights into whether an asset is in a bullish or bearish trend, helping traders refine both their short-term and long-term strategies. How to read candlestick charts? Interpreting candlestick charts is key to understanding market sentiment. A bullish candle indicates the price closed higher than it opened, signaling buyer dominance and an upward trend. This is typically represented by a green candle. In contrast, a bearish candle shows that the price closed lower than it opened, reflecting stronger selling pressure and a downward trend. This is usually represented by a red candle. Beyond color, the size of the candlestick body and its wicks offer deeper insights. A long body reflects strong buying or selling activity, confirming a decisive market move. A short body suggests market decision or minimal price change during the session. Long upper or lower wicks may indicate price rejection at those levels, pointing to possible reversals or weakening trends. Bullish candlestick patterns. Bullish candlestick patterns are formations on a candlestick chart that suggest a potential reversal from a downtrend to an uptrend. These patterns signal growing buying pressure and are commonly used by traders to identify entry points in a bullish market setup. Hammer. The hammer is a single candle bullish reversal pattern that forms after a downtrend. It has a short body near the top and a long lower wick, showing that all the sellers initially pushed the price down. Buyers regained control by the close. Hammer candlestick pattern characteristics appears at the bottom of a downtrend. Small body, long lower shadow. Signals buyer strength returning. Common in reversal trading strategies. The inverse hammer also forms up after a downtrend but has a long upper wick and a small body near the base. It reflects early buying interest, though confirmation from the next bullish candle is usually required to validate the pattern. Inverse hammer pattern characteristics occurs during a downtrend. Small body with long upper shadow indicates potential bullish reversal, requires follow-up confirmation. Bullish engulfing pattern consists of two candles. The first is a small bearish candle followed by a larger bullish candle that completely covers or engulfs the previous body. This shows a decisive shift from selling to buying momentum. This pattern characteristics: two candle reversal pattern. Second candle engulfs the first, appears after a down. Three white soldiers. This pattern features three strong bullish candles forming consecutively, each closing higher than the last. It represents sustained buying momentum and is considered one of the more reliable bullish candlestick patterns. These pattern characteristics: three consecutive green candles, higher closes with little wick shadows, indicates strong upward momentum, suggest potential trend reversal or continuation. Next one is piercing line. The piercing line is a two candle formation. It starts with a long bearish candle followed by a bullish candle that opens lower but closes above the midpoint of the first. It signals buying strength entering the market. This pattern characteristics found after a price drop. Bullish candle closes above the 50% of previous candle, suggests market recovery, early indicator of a bullish shift. Next one is morning star. The morning star is a three candle bullish reversal pattern. It begins with a bearish candle followed by a small bodied candle that signals indecision and ends with a strong bullish candle. Together they indicate weakening selling pressure and growing buyer confidence. Pattern characteristics: three candle reversal setup forms after a downtrend. Center candle shows hesitation, often confirms a new bullish trend. Next one is Marubozu. A bullish Marubozu is a single, full bodied candle with no visible wicks. It opens at the low and closes at the high, reflecting total buyer control during the session. It's a strong signal of continued bullish momentum. These pattern characteristics: no wicks, just a solid green body. Strong confirmation of buyer dominance. Common in breakout strategies, indicates confidence in price rise. Next one is Dragonfly Doji. The Dragonfly Doji appears when the open, close and high prices are nearly the same with a long lower shadow. This suggests seller had the upper hand early on, but buyers pushed the price back up, showing signs a potential reversal. This pattern characteristics: long lower wick, flat top, indicates rejection of lower prices, signal shift in momentum. Watch for confirmation candle after. Next, bearish candlestick patterns are chart signals that suggest a potential shift from an uptrend to a downtrend. These formations often appear at the top of price movements and are widely used by traders to anticipate selling pressure and identify potential exit or short selling opportunities. First one is bearish engulfing. The bearish engulfing is a two candle reversal pattern that appears after an uptrend. It forms when a small bullish candle is followed by a larger bearish candle that completely covers the previous candle's body, signaling a strong shift in momentum from buyers to sellers. This pattern characteristics appears after an uptrend. Bearish candle fully engulfs the prior bullish candle, indicates rising selling momentum, suggests potential bearish counterpart, appearing as a three candle formation at the top of an uptrend. It consists of a bullish candle, a small bodied candle showing indecision, and a strong bearish candle signaling a potential reversal. This pattern characteristics, three candle setup occurs after an uptrend, signals weakening buyer strength, confirms bearish shift when followed by downward price action. Next one is hanging man. The hanging man is a single candle bearish pattern found at the peak of an uptrend. Its small real body and long lower shadow suggest that selling pressure is emerging even as the price attempts to rise. This pattern characteristics forms after a price rise. Small body, long lower wick, resembles a hammer but signals bearishness. Often needs shooting star. A shooting star appears at the top of an uptrend and signals a potential reversal. It features a small real body near the bottom and a long upper wick, indicating that buyers pushed the prices up but sellers regained control by the close. Pattern characteristics appears in an uptrend, long upper shadow, small body below. Suggests rejection of an higher prices. Implies possible price decline ahead. Next one is three black rows. This pattern consists of three consecutive long bearish candles with lower closes each day. It shows a strong reversal from bullish to bearish sentiment, often confirming developing downtrend. This pattern characteristics, three strong red candles in a row, little to no lower wicks, each close lower than the previous day. Okay, indicates strong and sustained selling pressure. Next one is dark cloud cover. The dark cloud cover is a two candle bearish reversal pattern that appears after an uptrend. It starts with a strong bullish candle followed by a bearish candle that opens higher but closes below the midpoint of the first. This pattern signals weakening buying pressure and a potential shift towards a downtrend. This pattern characteristics, two candles bullish then bearish. Bearish candle closes below the midpoint of the bullish, appears after an uptrend, signals a potential shift to downside movement. Next one is bearish harami. The bearish harami features a large bullish candle followed by a smaller bearish candle that is completely contained within the body of the previous one. It reflects waning buying pressure and potential market hesitation at the top. This pattern characteristics, two candle pattern, small bearish candle inside larger bullish candle indicates weakening bullish momentum. Requires confirmation for a stronger signal. Next one is Marubozu. A bearish Marubozu is a long red candle with no upper or lower shadows. Okay, meaning the price opened at the high and closed at the low. It shows strong selling pressure throughout the season and often signals the beginning or continuation of a downward trend. This pattern characteristics, long bearish body with no shadows, opens at the high and closes at the low, reflects strong seller control. Useful for confirming trend direction. That's it guys. Candlestick patterns are not just random shapes. They reflect the psychology of buyers and sellers in the market. So keep practicing, backtest regularly and develop your own trading edge. Thanks for watching, and if you found this useful, don't forget to like, share and subscribe for more trading insights.